Hey, Investing Unscripted listeners. If you want to earn 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/investing unscripted.
Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I hope you're ready because Jeff Santoro, he was born ready. Jeff Santoro is the voice of the people. He is joining me today. My name is Jason Hall. But Jeff, you join me every day, don't you?
This is the most awkward opening to a podcast I think you've ever done.
Challenge accepted.
I don't even know what's happening.
Hey, everybody. Welcome to Investing Unscripted, where we ask and answer the hard questions about, I'm not going to do another intro. We're just rolling with this.
Yeah. I think at this point, people have come to understand that we are not professionals. And
Yes.
they're going to get what they get at the beginning of this podcast.
Well, I mean, we are professionals. We make a little money doing this, but we're not good.
We're not good at it.
This is there we go. You know who's good, though? Tyler Crow. He's good.
I never want to say those words on our podcast, but I guess he did give us the idea for this episode, so we should throw some thank yous his way.
You'll allow it. You'll allow it this time, right? Yeah. Now, Tyler is actually good at finding stocks. He turns over a lot of rocks, and we have a chat group together with Tyler and a few other colleagues and friends in the investing community. And he regularly gives us ideas and thoughts for shows and just questions that he asks rhetorically sometimes that are good. And he had a good question. It was, is it better to turn over lots of rocks or to deep dive on fewer ideas? And well, sounds like a really great conversation.
What I like about it, and I think this will be a little bit of a challenge for you and I, because I think to some degree, we're going to have to speculate on what it's like to have to get new ideas because we're in the lucky position of never really being short on ideas. And that's just by virtue of the fact that we both do either full-time or part-time work in this world. But that's not everyone's situation. It certainly wasn't mine before I started to do the contracting work that I do now. And same thing with you. So it'll be fun to kind of talk about how we do find ideas now and how we might find ideas if we didn't have this seemingly infinite source of ideas.
Right.
And actually, I have some aspirational things as it comes to finding new ideas that I want to talk through later. So it'll be a fun conversation. But before we dive into that, Jason, we haven't done any housekeeping on the front end of the podcast in a while. And I just want to take a few seconds here to remind our loyal and wonderful listeners that if they could take the time to give us a 5-star review and a written review on Apple Podcasts, it would really, really help people find the show. In
our other listeners, you can do the same thing too.
Yeah, right.
So
not just the loyal ones. No, but in a world where Twitter has not really been the platform it used to be in terms of driving engagement and trying to have people find our podcast, that's the best way for us to get the show out there. So we would appreciate it.
yeah, the easiest thing you can do is give us a rating. The second easiest thing you can do is a rating and a review. The easiest thing you can do that is absolutely the most effective is to tell somebody about us.
Yeah, absolutely.
Lie and tell them that it's good.
Right. Yeah, you don't have to tell the truth. You just tell them it's great.
Right. Exactly. Okay. All right. So back to Tyler and his idea. So it's interesting because those that watch our YouTube channel, I do a lot of videos with Tyler where we dig into individual stocks or 10 to 15 minute videos. Tyler has a newsletter service that he does, a stock discovery service that he runs, talks about his own portfolio, talks about some IPOs, but also really digs into kind of undercovered massive winners, big long-term winners. And it's called Misfit Alpha because of our relationship with Tyler. We don't make any money for this, but it's a nice thing for you. If you can get a discount on his paid service, misfitalpha.com/unscripted. It'll be in the show notes and we'll have it in the transcript too if you want to check it out. So his idea, Jeff, what's the best way? And I think there's a lot of answers to this that could be the right answers. Better to turn over lots of rocks or go deeper on fewer ideas? Where does that take you to start?
I think about this a lot because as someone who's been paying attention to investing in stocks only since the beginning of 2020, I've done that in a very unique time. During my like beginning months and years of learning all this, we were in this crazy post-pandemic bull market. Twitter was still, it was a different platform, let's just say, than it is now. It was before Elon bought it. And it was very overwhelming, but also very easy to just find tons and tons and tons of people talking about stocks online. And, we've probably said this too, but it is a commonly repeated phrase that,
Hmm.
if you're interested in the stock that everyone's talking about, you're probably going to pay too much for it. And I largely agree with that.
Yeah.
That said, there are massive winners that have been popular, talked about stocks for a long, long time. And so it's not like you can't find good ideas there. So I have that thought in my mind, like on one side.
Right.
I understand that the more people talk about it, the more the price has been driven up, the more it might be expensive, but you can still find big winners there. All of the big tech companies, the Mag 7, all of them are examples of that. People have been talking about Apple for 20 plus years, and it's been great that whole time, right?
Yeah.
And then there's the other side of it, which the intellectually curious part of my brain is interested in, which is what Tyler does in his service and what people who focus on micro caps or small caps or international investing, finding those undercovered, unfollowed, big winners, solid businesses that no one really knows about.
You
Because
could,
that's
yeah,
where,
you could read 50,000 new words written about Apple every day.
right.
Some of those companies that Tyler and mentioned, there's other writers out there that focus on small caps and that sort of thing. There are companies out there that don't have 50,000 total words written in their history
Right.
and in
And
like a publicly consumable format.
And I understand the logic behind that, right? If you find a company that there's no analysts covering or one analyst, there's a greater chance you're going to find a dislocation in the pricing of that stock, right?
Yeah.
The part that I struggle with as someone who I would say probably has learned enough to be more knowledgeable than the average retail investor, but still not super comfortable flying solo, so to speak,
Mhm.
is there's also, with less people paying attention to it, I think there's a higher possibility that someone like me misses something super important,
You're getting it wrong. Yeah.
right?
Yeah.
I'm going to see this. I'm going to put all the dots together and say to myself, I just found the next 10 bagger and no one knows about it. I buy it. And then I find out it's a massive fraud. And it was actually really easy to see that if you weren't an idiot like me, right? That's like the fear in the back of my brain.
Yeah. Yeah.
Which is why if you find someone who writes about those types of stocks that you trust and is a good analyst of companies and not just trying to make a quick buck, that can be a great resource. But I just think those are the kind of like just my initial thoughts about where to go find ideas and how to turn over rocks. Like to turn over rocks and make your own decisions, you have to know a decent amount or else you're just not going to know kind of what you're looking for once that rock's turned over. So that's why I think most people gravitate towards the things they know, the things that other people are talking about, the things that are, overcovered and very popular because, more eyes means less chance that, you could still find a fraud, but less chance that there will be one if a lot of people are paying attention. So those are my initial thoughts about like kind of the two sides of that coin.
Well, this kind of, it's a good segue into our first kind of leveraging your expertise topic, but I don't want to be too cynical before we talk through that. I don't want to be too cynical, but I think broadly, Jeff, I think you're right. You're definitely far more, you know, y- working in education, you deal with, a lot of just regular people that don't follow or aren't interested in investing. Talking to my wife who works in a professional field, same thing. I work full time in this. The majority of people I'm talking to are sophisticated investors, right? It's easy to forget how little the average person out there knows. Like they don't understand that a stock that costs $100 might actually be cheaper than a stock that costs $10,
Right.
right?
Yeah.
Just the basic lack of education about it is clear. And you combine that, lack of sophistication with human nature, which is most people, they don't want to form their own objective opinions. They want to borrow one that feels good. And that's the danger of just kind of following the crowd, especially on things like social media, especially today, because it has become so much less engaging, and harder to find people that aren't just farming for engagement versus putting forth good work and trying to get engaged and have a meaningful conversation. So leveraging your own expertise, I think, is critically important. If you have it, it's just figuring out what it is.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. Well, and it's also, yeah, it's your own expertise. It's the time you have to devote to it, right? Like that's my biggest issue is I don't
Mhm.
it's a time management thing for me. Like I'd love to be able to devote 8 hours a day to learning more about this because it's the thing I geek out on the most, but that's just not an option for me. So I have to find
Yes.
other ways to kind of get at it. So, but I do think the next kind of place I wanted to kind of pick your brain is not so much leveraging your expertise, but leveraging your network. Because anyone who's listening to this podcast is interested in investing enough that they have some sort of network of information. And maybe this podcast is part of it, but it could be social media accounts, it could be newsletters or websites that you frequent, it could be YouTube videos, it could be friends you have that like investing. Maybe you're a member of a service like the Motley Fool or something like that. And I think that's a perfectly good place to go looking for ideas too. But like with any of the things we're going to talk about, there's pitfalls that you have to watch out for. So, what do you think about leveraging your network, using the things that you consume as a someone who's interested in investing as a way to find new stock ideas?
Now, for me, this is the by far how I accumulate the vast majority of my ideas.
Yeah, same.
Again, working and investing, I can't have a conversation without a single colleague without new ideas coming up or rehashing existing ideas, old ideas, things like that. So I think for people listening to this podcast, like yourself, when you first started, before you started doing anything in terms of like the side hustle stuff, the gig work that you built, you were building a network, right? You were making contacts, you were reaching out to people, you were getting to know people. And I think that I would like to encourage more people listening to this to find, because there's groups on Facebook that investing clubs and things like that that you can get involved in, that I think more people should, because what it's going to help you do is not just accumulate more ideas, but there's a little bit of kind of a filter at the top of your funnel that you get there. Sure, you might not find every idea. Maybe the more obscure harder to find stocks unless your goal is to read, 20 10Ks from 20 different companies every month. You're not going to find everything, right?
Right.
But it is going to at least kind of start helping you filter down to some pre-vetted ideas that then you can kind of kick off your own. It's more gardening than hunting, if that makes sense.
Yeah, the thing that I think about when it comes to things like that, like a Facebook page is or a Facebook group or like an online forum, which is
Yeah,
not something that you see as much of it now as when we were
right.
like in our 20s.
There's tons of great stuff on investing on Reddit, and
Yeah, Reddit would be a good place. But I guess what
yeah,
I think it with wherever that is, what I've sort of come to realize is a lot of that is you get what you put into it. So for example,
exactly,
if you're
right.
just going to read and not engage, then you're limited to what other people are going to put out there. And there are some people who will put everything out there. So what I've seen people where I've seen people be successful in those settings is by asking asking the hard questions about investing, right? So asking questions like, I'm really interested in this company. What's the bear case?
Yeah, right,
What should
right.
I what's a pitfall for this company? Is there someone here who doesn't like this as an investment? Tell me why. You can even do that on Twitter. I know that Brett Schaefer, who's
Brett
half
does it a
of
lot.
the Chit Chat Stocks podcast, a friend of ours, he's good about that. Like if he has a new
Friend
idea,
and
he's
also, advertiser.
yes,
Yeah,
that's true. He is an
right.
advertiser on our podcast. You should everyone should check out after you've listened to our episode each week. You should go listen to the Chit Chat Stocks podcast because it's
Not
wonderful.
before,
Not
after.
before, after, right? Priorities. But he's good about, hey, what's the bear case for this company, and just seeing what gets put out there. So that's an example of you know trying to getting out of the network what you put into it.
Yeah, what you put into it is gonna factor what you get out of it, there's no doubt about that, but I also think there's a little bit of when it comes to leveraging your network, what you put into your network too, the value of your network and knowing the difference. For example, if I see something retweeted on Twitter by some people that I follow that I don't actually know, and I feel like they have a pretty good reputation, but I've never really looked at their returns to find, even if it's even publicly available, for example, I know that I'm going to take that with a much larger grain of salt than I am something from an analyst that I've worked with for 5 or 10 years,
Right.
for
Yeah.
example. And just here's an example of one. So I've got this big focus on investing in more fixed income. So of course, immediately I've gotten interested in another dividend stock that I wanted to buy that that I typical me, right? But no, I decided to. So today I did it today. So this is about a week before you're going to hear the show. When we're taping this today, I opened a position in UPS because of reading a little more about the company and hearing about it from an analyst that I know. And I've got some preconceived notions about UPS. It's hasn't been a great stock over the long term. It's sold off a ton over the past year or so. Even before that, kind of from the peak, if you look at its long term results, it wasn't some massively market beating investment. But the thesis has kind of changed. The stock price has come down a lot. They've new management, new CEOs come in, and they're really focused on creating value for investors and growing earnings and margins by kind of shrinking the business away from commodity parts of logistics and shipping and focusing on the opportunity where there's growth in higher margin things. So they're kind of refocusing the business in some smart ways. Long story short, I didn't put anywhere near as much due diligence into this investment as I would if you had told me about it, Jeff, for example, because I don't
Yeah.
trust you as an analyst.
And you shouldn't.
So,
I'm sorry. What is
no,
this
seriously, I was
UPS
like,
you speak of? I'm not familiar with this.
no, that's funny. But no, but seriously, like if I had just seen something about it on Twitter or some other social media, I would be reading multiple 10Ks going back a few years, in addition to transcripts from management, looked at more recent quarterly results to see the trends.
Right.
Are things
Right.
happening based on what they're telling me? And in this particular case, because I do know the business relatively well, I've got that base of knowledge there. And based on this analyst that I trust, I decided to open a starter position now.
You hit on a couple things there that I think are important and things that I try to do in my own process when I come across any kind of idea, whether it's for out in the wild, so to speak, or from someone who I know and trust. And that is,
Yeah.
I view people I trust as like like a screener. We'll talk about screeners later,
Hmm.
but I try not to take someone else's idea wholesale. Now I've done it and I'm not saying I haven't, but I try not to. And here's what I mean. I'm going to still try to run that idea through my mental framework for if I want to invest in that company, like I would if I came across it randomly with no recommendation. And my I think that's a good way to view any idea you come across out there, whether it's on a newsletter, social media, or even a paid service. You and I both work for, in some capacity, the Motley Fool, which has tons and tons of stock ideas depending on what services you subscribe to. I don't recommend people blindly buy those. I think you should still, read what's written by people who know what they're talking about, but still kind
Yeah.
of run it through your own framework because nobody is a perfect stock picker, right? Like
Right.
as much as someone might have a great track record, and some of the Motley Fool services do, not every stock is a winner, and they wouldn't claim it is. I'm not saying anything disparaging. So to me, there are some people who I trust very, very much when it comes to investing, and they will pound the table on an idea, and it just doesn't fit with the way I see the world, so I don't buy it. And I could be wrong. I could be missing out on a great winner, but I think that's I think that's a good way to approach any kind of idea, no matter where it comes from, right? And I'm sure you did some level of that even with this UPS purchase,
Yeah.
but I think it's easy to say to yourself, "Oh, I subscribe to this service. I'm paying these professionals," or forgetting that I have a financial advisor, right, who I pay a percentage of my portfolio and they pick my stocks for me. If you're interested in this enough to be listening to this podcast, I think you should still try to run those ideas through your own kind of mental framework.
Yeah, I agree, and I think, but no, you're right with UPS. I don't want it to be like this flippant. It's like, oh, Fred the analyst told me about it, and I flipped out my Fidelity app on my phone and bought it right then. No, I took a day or two and I read the past couple of earnings releases and did some due diligence, looking at valuation. And like one thing I figured out is like I looked at the valuation was 21 times earnings. That's not cheap. That's not cheap for a company like this. It's like, well, what's going on? It's like here's their plan to grow free cash flow per share, to grow earnings per share, and earnings per share is down. That's one of the reasons the stock's down because the challenges with the shipping environment, the fact that their results have weakened. It's like, so you start normalizing. You look at where the stock price is today versus where they're trying to take the company, and that's really you want to be thinking about what you're paying today is to buy future results, right? Not past results. And when you look at a PE ratio, it's completely past results.
Yeah.
And so you really kind of, again, using a mental framework to think about how you value the stock, whether it's a discounted cash flow model or just like a back of the napkin thing where I looked at the multiple today versus where the earnings were, not where they are, but where they were, just to normalize the business back to a healthy level. And then where they want to take it beyond that, doing things like share repurchases and just to create more value. It's like, you know what? Okay, this falls right in line with where I want it to be. So you have to have those tools in your toolbox to evaluate any idea. One thing real quick I want to comment on, you were talking about like with like the stock discovery service, like Stock Advisor, for example, they're giving you ideas, the stock idea service. Our friend Simon Erickson, Seven Investing, doing something similar. Tyler kind of a little bit the same, even though his is more just like research and he's kind of showing his homework. The idea there, like I said, it's really to give you ideas and then for you to take those ideas and go act on them. And my experience from talking to a lot of people is it's that you borrow the ideas that resonate with you, ignore the ones that don't resonate with you and never do any due diligence. And you get exactly what you deserve by doing that, which is usually poor results. I do
Well,
think with those sorts of services, if you find one and it's really good stock pickers and they have a proven track record of delivering the kind of results that you'd be happy with, you either buy the whole thing, you follow it and you say, okay, I'm going to take $1,000 a month or 200 or whatever. And you follow every recommendation they make. You don't cherry pick, right? You're paying for the service to get their best work. Follow their best work or use it as a jumping off point to actually do your own research and follow the ideas or not based on doing research, not your reaction to reading the stock ticker.
yeah, no, I agree with that. So we're going to pivot into some other ways of thinking about this, but one last thing I want to say about a way that I've thought about how to process all the information that's out there, especially the stuff that's available for free, I've noticed that a lot of what's out in the wild that is presented as analysis is really just like information slash recap. So
Yeah.
what I like about what
It's repackaged information to market you to whatever they want to sell you or sell to you or sell you.
well, yeah, there's that part of it, but that's not even the direction I'm going. I'm talking more about what the author thinks is analysis, but it's really not. And here's what I mean by that.
Yeah,
When I was
they're just reporting the news. They're just
yeah,
distilling stuff down.
I'll give you an example. When I was first starting to write articles for the free side of fool.com several years ago, one of the pieces of feedback I got from the editor that was training me was essentially could be boiled down to so what? Because
Yeah.
I was presenting information and stopping short of any kind of analysis. And what I like about your example with the reason you decided to open the position in UPS is you talked about the so what of it. You
Mhm.
know, the stock price is here because of these reasons. And I believe those reasons. And I think those reasons will change. And that's why, like that sort of thought process. And I think that's a filter that we can all use when we come across a 1,000 word write up on a company. Is the information in there just here's what the company has done, like to your point about what past versus future, or is
Right.
it actual and here's why I think right now the market is mispricing it, or here's where I think it can change, or here's why I think they're at an inflection point. And that takes a little bit of like you have to kind of think, okay, is this really telling me anything that's so what-ish, or is it just here's the information? Like it's the what
Yeah.
versus the why kind of a thing.
Yeah, no, I think you're exactly right. I mean, and I think it's the difference between repackaging and original content. Like Alex Morris, The Science of Hitting, incredibly in-depth original analysis that he's providing versus, and I don't want to, this isn't a diss, but compared to like Brad Freeman provides these earnings takes that he does and what Brad is doing. And again, this isn't a diss. Brad's like distilling down what's in earnings to like this one page quick take, but there's not deep analysis there. It's not intended to be, but there's a lot of people that don't take the time to really think through the difference between those sorts of things. And
Right.
Jeff, I think that's the point that you were trying to make is if you're looking for in-depth analysis, the what and the why, make sure it's coming from people that you trust and it's useful. And if what you're getting is just a regurgitation, then use it to form an opinion.
Yeah. So I mentioned earlier, the idea of using a screener. So let's go there because I think for people who, if you're someone who's like, I want to find new ideas, the easiest kind of go-to thing that people will tell you in response is go use a stock screener, which is essentially a website you can go to. There's a bunch of free ones out there. Your brokerage will probably have one, and you can plug in criteria and just narrow the thousands and thousands of companies that are out there down to maybe hundreds or maybe dozens or maybe one. So you could, just as an example, I want only companies listed in the US with this market cap range that are profitable, that have earnings growth above 10%, like all these different criteria, basically anything you can think of. And it will just screen out the ones that don't fit that criteria. I played around with screeners a lot when I was brand new and I was like just fishing for ideas. And it's hard because when you're new and you're doing that, you don't really know what criteria to choose. I was just picking like the big, the normal things that like make sense to anyone, like lots of revenue. But then you're down to like 10,000 companies, so
Right.
it's not super
Right.
helpful. So I'm curious, I don't know how much you use them now, but were you ever a user of screeners? Do you use them now? Are they helpful to you at all?
I still do use them a little bit. And I was talking to a friend of mine about this actually just in the past couple of days. I definitely don't use them as much as I think other people can. And I think broadly screeners can be destructive as well as incredibly useful. So what I mean by that is that they're a great way to exclude good ideas and find bad ideas if you use them improperly. So for example, a lot of times people will try to chase value or try and find high yield stocks and they end up buying broken turnarounds and dividend traps, right? So you buy a dividend stock that the yield looks like it's going to be really good, The reason it looks like it's going to be really good is because everybody else is sold and driven the stock down because they know the company's going to have to cut the payout. So you're not holding somebody else's bag and you're not going to get the dividend you were expecting, right? And I think the same thing can happen with like turnaround plays because sometimes stocks can look really cheap when they're actually expensive. Again, prices come down, earnings haven't come down yet, but everybody knows it's going to happen except for you and 5 other people that used that screener. So you don't do any due diligence besides the screener, right? The screener is simply a tool. It's a discovery tool, and then you have to go from there to take those few tickers that you got based on the things you screened for, and then you actually have to go do the actual work,
Right.
which is okay. So why is this yield 10%? Why is it trading for a PE of 8? What's the story of the company? What are analysts saying about it? If you go, and this is one of those times where analyst ratings can actually be helpful. If you go and you look, and it's like last time they reported earnings, they had 3 earnings down, analyst downgrades. Like, here's the clue. Then you can start doing a little bit of research to figure out and what you should be doing. And you mentioned this before a little bit. Kind of talk about the bear thesis when we're talking about maybe reaching out through your networking, talking to people. We should all like put this tool in your toolbox. This toolbox is the hammer, and it is the destroy the bad idea hammer. You should spend the majority of your time when you found an idea that you think it's the idea, the rest of your effort before you buy the stock or before you walk away should be figuring out why you should not buy it. Not why you should, but why you should not.
Yeah. Screeners are, like you said, they can be really helpful, but they can also be, it is a first step, I think, and nothing more.
Yeah.
One place that I have found them to be helpful is, all things being equal, if you're able to find a great company, you'd rather find a great small company than a great large company, right?
Right.
Like,
Yeah.
all
Yeah.
things being equal. So I've used them for just finding small caps or
Right.
even micro caps, right? Now that's when you get to like the under a billion and under 500 million, like you're in a whole different territory of stocks that we're not going to talk about today. But I've sometimes just, when I wanted to play around with the screener, just said, 1 billion to 2 billion, and very basic things like profitable, positive cash flow, revenue growth above 5%, right? Just sort of, and just kind of see where it goes. And it'll give me 300, right? Or 500, something like that. I'm not going to go through every single one. But actually what I end up doing, and this isn't maybe the best way to turn over unfound ideas, but I look for things I've heard of, right? So like maybe I'm skimming through and I'm like, oh, I've heard of that company. I see it on the sides of trucks in my state. I didn't know that was a publicly traded company. And then I might go look into it. So but it is just kind of like a first step. In terms of going from there, though, I want to plug one of our sponsors that people have probably heard us advertise over the past several months on the podcast, which is Yellow Brick. It's a really cool site where you can just plug in a ticker or the name of a company, and it aggregates write-ups like stock pitches and articles about stocks about that company on the bull side or the bear side. So if you come across an idea, especially if it's a smallish company that you haven't heard of, and you're like, oh, I want to see if anyone else has ever heard of this or written about it. Like a lot of times you'll find something in a screener that someone has written about. And again, it's just another piece of information that you can go, because maybe someone wrote a bear case on it and said how, it's this terrible company and it's about to go bankrupt and don't buy it. And that's just one source. You should go try to find more. But I wanted to plug our sponsor there. It's just another avenue to, once you do the screener, to kind of go do that next step of actual research.
Yeah. So one thing about screeners, so your browser, your broker probably has a pretty good one built in. I'm a Fidelity customer,
Yeah,
so
Fidelity's got a good one.
it's got a lot of things. So for like, I think one of the really useful things you can do is, here's an example, and I'm going to say what you already said, but I want to be like clear about like these things. So you can put in revenue growth. So like the Fidelity screener, you can pick the past 5 years revenue growth rate, and you can screen for a specific range of growth rate. So like 20% per year plus average. And then market cap. So like you can say 1 billion up to 7 billion, right? And usually what I'll do when I'm doing those sorts of screeners is I'll go bigger than like whatever numbers were in my head, because you don't want to exclude a company that's close to what the range you were thinking
Right,
was.
right.
You know what I mean?
It's 6.1 billion, and you put the
Right.
screener at 6 billion.
Exactly, right? So whatever metrics you're thinking about, usually I expand it a little bit. As an example, like dividends, if I'm looking for a certain yield, I'll usually go a little lower than that yield, like the range that I want. Because again, you don't want to exclude a company that's really close, especially if you find out that that company's dividend growth rate is really, really high. Because you can buy a company with a 3% yield that's growing the payout 5% a year. And over the long term, you're going to be a lot better buying a company that pays a 2.5% yield today, but they're growing their dividend 10 or 15% a year, right?
And by the way, since dividend yield is inversely correlated to stock price or correlated to stock price, right?
Yep,
Like a bad week for that company or a good week for that company could put it in or out of your range, right? So that's just
exactly.
another reason to go wider in your range than what you're actually looking for.
Yeah. The other thing too that's useful is being able to filter by sector, and then you can get to the industry and subsector within it, which can be really useful. So, for example, like if you're looking for low PE stocks, price to earnings ratio stocks, but you also want a good dividend, well, you're gonna miss almost all of the REITs
Hmm.
because their PEs typically are higher because we've talked about it before. FFO, funds from
Right.
operation, is the PE for that sector.
Yep.
So you'll miss them. So it's a way that you can maybe focus on specific sectors by just looking within a sector. But also it can be a way if you want to exclude a sector. So you can look at these growth rates, but you're like, you know what? I am not interested in any company in healthcare, or, I don't want tech stocks. I want companies, or I don't want material. I don't want mining stocks. Gold prices have been up lately. It's like, you know what? I don't want gold miners to pollute this small cap field because all their revenues are up because gold prices have gone up. You know what I mean? So you could use it to exclude and include particular groups as well. But back to Yellow Brick that you mentioned, I want to mention FinChat too, because one of the things that you typically don't get with your research tools that are built into your broker are like KPIs.
Hmm.
So things that are specific maybe to a certain industry or to a certain company that are really important that I know FinChat does a really, really good job with.
Yeah.
And FinChat and others are starting to add it, and you're going to see more and more, and eventually it'll filter down. But like generative AI being built in to where you can just ask it a question
Yep.
and it can start giving you a starting point, and then it will suggest follow up questions from there and kind of help guide you through the process of helping you figure out what you're looking for. And those aren't free. You pay for those. But again, you get what you pay for. And if you think about the amount of money people will spend over their lifetime uh, investing in great ideas, sometimes spending a little bit for a useful tool can make you a lot more effective at turning over more stones.
Hey, everybody. We'll be right back. But first, a word from our sponsors. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part? If you act now, you can potentially lock in a 6.9% yield until 2028. The new bond account, only at public.com/investing unscripted.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
I have a couple of questions I want to ask you about your own process. We've talked a little bit about how we do this, and I think we're in a unique position from an idea discovery standpoint. But one of the things that I've come to think about recently is there's really no rush to find new ideas a lot of the
Yeah.
time. You know, I'm
Often
you and
when we
I,
feel the rush is the worst time to be rushing too.
yeah, and I think a lot about, let's say I had to start over right now, right, with my current level of knowledge, but I woke up tomorrow morning and I own zero stocks and I'm building a new portfolio. I would probably advise myself to have like a big chunk of money in an ETF that tracks the S&P 500.
Yep.
And then if I'm in a tax deferred account, at least sell off chunks of that when I'm ready to buy a new stock, right? Or some
Right.
system like
Yep.
that. Have a lot of
Yep.
cash and just kind of when there's an idea I'm excited about and I've done research on, buy it. And don't be in a rush to have 100 stocks in a month,
Absolutely.
which is what I absolutely did when I started. I think I went from 0 stocks to 100 stocks in probably 6 months.
Which
Now,
is way
tiny,
too
tiny
many,
bits of those
way
stocks,
too
but
quickly.
yeah, I was just buying everything and $5 of this and $10 of that. And as soon
Well,
as I
there's
got
there's
fractional shares, man, I was like,
well, there's no way you can build any level of conviction
no,
doing
no,
that,
no. I
right?
was
No
just,
way,
yeah.
no way at all. And again, like the UPS thing is, I know I keep going back to that. There's recency bias in my brain here, but because I've have 15 plus years of experience and knowledge base that's there already, UPS is not a new idea to me. It's a new idea to me now, but it's a company and a business that I've followed for a long time in an industry that I understand pretty well. So I'm leveraging my existing knowledge base to make a better decision more quickly than I could have made it, 5 or 10 years ago.
All right. So you may not have an answer to this question because maybe you haven't had your own like idea that you found on your own in a long time just because of the work you do. But can you think of a stock that either you own or don't own that you totally found on your own? Not from like a friend, not from a colleague, not in a service, like you were doing a screener or whatever. Like, what's the closest thing you have to a stock that you can say was your idea? Because I have a couple that I never bought and I for good reason, but I can say that I found them on my
Probably the closest that I can come up with is investing in Ryman Hospitality Properties
Hmm.
back in late March of 2020. And even that one is not completely originally mine because I had done some research and I'd read some things out there about Ryman. They were kind of going through this turnaround period. But even I can't claim full like original idea for that one because kind of on the way down, Matt Franklin and I think it's 2 episodes in a row Matt's come up. We were like during the pandemic, we were texting like 20 times a day talking about ideas. Like we were both like rubbing our hands, getting ready, seeing this, once in a decade opportunity. I want to acknowledge, yes, it was a terrible, scary, scary time.
right, but your investor brain knew what it was seeing.
Right,
Yeah.
right. So, and that quickly became one of the most obvious, like long-term opportunities because if this company doesn't come back, we have much bigger problems, sort of thing. And there was a little bit of the same thing with Tanger Factory Outlets, where I had really followed that business super closely for 5 years heading into the pandemic. And luckily they had made like all of the moves before the pandemic to like fix their balance sheet and start reducing like their bad properties, like selling off properties that weren't productive and that sort of stuff. And that one actually is an older idea than Ryman. So I guess maybe I could say Tanger, but I didn't find it in any of it wasn't from any stock picker services I was a member of or any of that kind of thing. So probably those. And then more recently here, when we had the bank downturn, there were a lot of banks that I followed for a long time that in early 2022, it became clearly evident that this was the time to be buying bank stocks.
Yeah.
But yeah, so there's a few.
So as I'm thinking about the two that I'm going to share, I realize that they're actually going to be cautionary tales about screeners because I think that's how I found these. So I'm gonna screen share really quick while I talk through this so the people watching on YouTube can see it, but I will talk through it for the people who are not. But when I was brand new and I was searching for stocks, I came across this company called Cytosorbents. I don't remember what they do. They're a biotech.
It doesn't matter
And
what they do.
so you
They
can
they
see on the
raise
chart
they
here.
raise capital from investors and burn that capital developing products.
Right. Now, I didn't know any of that. Here's what, but I clearly found it with the screener because if you look in early 2020 on this chart, which
To
this
the
stock
moon.
is skyrocketing and crushing the market, I probably was putting things in 80% plus revenue growth and things like that. And this came up and I noticed it was headquartered like 15 minutes down the road from me, right? It's a New Jersey company. And I never bought it. I just sort of like kept it on my like radar to kind of keep track because I was too scared to make that decision on my own, but I wanted to just see if my instincts were right. They were not because as this chart shows, it is down 73% over the past 5 years while the S&P 500 is up 107%. And then similar to that is this company called Wrap Technologies, which has an even wilder chart from back in 2020, and they are sort of like Taser, except instead of shocking people, it shoots a web kind of thing out and like
They're
wraps.
like Spider-Man technologies.
Yes, yes. And I actually looked into the company a little bit and I read about it and I was like, oh, I could see how this could be like a thing police could use and stuff like that. And then I was like, maybe, maybe Axon buys them and incorporates them. No, this is also down like 60% over the past 5 years, but it just goes to show you like, depending on when you're using a screener, what you're looking for, you can absolutely trick yourself into thinking you found the next big thing. So I'm yet to come across an idea I can claim was mine that was actually a good investment, but those are two that I was smart to avoid and did not buy.
So cytosorbents, Jeff, it's obvious what they do. They sell a cytokine absorbing column. It's a blood purification technology based on porous polymer beads that act like sponges.
Yeah. No, I actually do remember. I know that that's what that, if you read me that description, I would have told you it was that company.
So I read
I
all of those words, but I still do not
Yeah.
know what
I
the
just
company
remember
actually
something about
does.
little beads and that it absorbs stuff and something about heart attacks.
Yeah. Inflammatory mediators, cytokines. Yeah. So I still don't know.
So
Yeah. So you
all
found
right,
two penny
here's
stocks. Excellent. Excellent.
yeah, it
Excellent
wasn't a
job.
penny stock back then. It had skyrocketed to like $7, I think.
You found two future penny stocks.
Yeah, that's
Nice
right.
job. Nice job.
All right, here's a question for you. How many over the course of like a year, how many new stocks do you think you act on in your average year versus just adding to things you already have?
Probably 10.
Like 10 new positions in your portfolio per year on average, you would say?
Probably. But in terms of as a percentage of my portfolio, I would say those 10 stocks are probably on average, I would say 8 of them are probably 3 or 4% of my portfolio.
Yeah.
Right. Probably 4%. There's half percent positions are smaller starter positions. And a couple of them, I'll take, 1 or 2% positions because they're like UPS example. I took a little bit larger position because it's predictable. Like I feel
Yeah.
relatively
Not as risky as some micro cap.
yeah, maybe doesn't have the high ceiling, but it has a much higher floor, right?
Yeah.
So that's probably the difference. And I can see that number going down. What
Well,
about
yeah,
you?
if you're trying to transition away from stocks into bonds, yeah.
Oh, I'm old, Jeff.
So
I'm old. So old.
Yeah. I won't make too many old jokes in this episode. People can go back a couple and hear that. I'm probably on a pace right now for like 1 or 2 a year. Like that's how much I've really tried to slow. I've really kind of come around to the whole, like, you don't have to swing at every pitch. I've gotten to a point, I think I'm down to 40 stocks in my portfolio. And I would say I have like enough conviction to add to the vast majority of those right now, like
Mhm.
at varying degrees of conviction. But so I feel kind of lucky that I like my portfolio and I feel like I have a lot of companies I still have high conviction in there. So I don't feel compelled to like go search for a new thing. But I have a watch list of ideas. It's not a lot of stocks. It's like 5 that I like the business and I'm interested in, but for whatever reason, I can't bring myself to buy it. For some of those, it's I just the number one, and I'm going to keep talking about it until I can actually bring myself to buy it, is Costco.
Yeah.
I get that, it's going to probably always be good and expensive, but it's like 50 times earnings right now. I just can't.
Let me give you the most important detail about Costco that tells me this is not a time to buy. Like you said, 50 times or like 58 times free cash flow right
And
now.
I would pay 35. Honestly, I would.
But
'Cause
here's the
that's
thing.
but
Over the
not
past 5
50.
years, earnings per share has doubled, just about doubled. That's pretty good for a company the size of Costco and their business model and all that kind of thing. The stock price has more than tripled.
Right.
That's multiple expansion and multiple expansion isn't always a bad thing. Sometimes it's you bought something that was deeply discounted, and if they could get it right, price was going to come up, the multiple was going to go up too, and the business was going to improve. With Costco, the business is perfectly fine, but 50 times earnings, that is a high premium to pay for a business that's growing. They grew the revenue last quarter 1%.
Yeah, but it is a freaking fantastic business.
It's an incredible business.
Yeah.
At the right price, it's a great investment.
Right. So that's kind of where I'm at. Like I'm only buying one or two things a year, probably, maybe three. But I have, so for example, 3 years ago, everything on my watch list I would own right now, right? Low
Yeah.
conviction, high
Yeah.
conviction, expensive, cheap. I would have just bought it and been like, YOLO, I'll see where it goes. And some of those have worked out for me over time, but I'm just trying to be a little bit like, and then even when I do buy, I'm still buying like a little tiny starter position and adding to it over time. Like I'm not backing up the truck and buying a whole lot of anything. But I'm really trying to not balloon my stock portfolio. I'm trying to whittle it down. So yeah, probably only like one or two per year.
Yeah, Jeff, I think we've pretty much hit all the topics we wanted to go over. Just a couple things to kind of wrap up the show I think are super important. Getting back to that, the idea of having the toolbox of tools and stock discovery and kind of where it fits in the cadence of your process. I think some level of diligence is so incredibly important, and factoring in where's the idea coming from, how much conviction do you have in that idea versus how much conviction you're borrowing, how to build conviction. And the biggest thing to me, I want to say it again, is like having that hammer, right? That tool of really getting, because you build your conviction the more you spend trying to find reasons to not buy the stock
Mm-hmm.
and continuing to run into dead ends. And you're going to learn like where are the pitfalls, and you're going to go into the investment with a much higher degree of confidence and understanding of the business, and far less likely to get completely caught off guard.
Yeah. Yeah, I would agree with that. I think my little recap of the conversation is you can find ideas anywhere. Like and I think but you can't just take them once you find them, right? I feel like
Yeah.
everything we talked about is sort of a step one in a process. Whether it's a really detailed write-up from someone you trust, whether it's a screener, something you found in a screener, whether it's something you came across on social media, like I think all of it should be step one in anyone's process. And then there should be something you have as part of your stock buying process that
Yeah.
you throw everything through. Like for me, it's making my spreadsheet, like I talk about all the time. If I find a new idea, the first thing I'll do is I'll plug all the data in, or I'll go to something like FinChat and look at, if I don't want to have the time to do it, I'll go look at all the same things visually prepared by that website rather than me manually typing them in to see trends. Cause that's how that's my process. That's how my brain works.
Yeah.
And then I'll go read some stuff. But that's me. Like everyone needs to have, some people think I'm absolutely insane to spend the time to build the spreadsheet. They'd rather just go to a place like FinChat and look it up.
Well, correct me if I'm wrong, but I think part of that process for you is not just the manual process of doing it, but you're thinking about it and you're revisiting old data as you're going through your process, right? So it's giving you time to kind of process the information as you're building out your
Yeah, no,
spreadsheet.
I like what I do. Like
Yeah.
it
Yeah.
works for me, but I
Right.
absolutely understand why someone else would look at me and think I'm absolutely insane when I can just go to a website like FinChat and type in Ryman Hospitality Properties and just see it all visually prepared right there. Like I get it.
Yeah.
So I think, but my point is I have my way of doing it and everyone needs to find their way of doing it. And that needs to be the thing you do after you find the idea.
Right.
After that initial interest is there, like you got to have your own sort of process. Like that's the kind of takeaway I have from this conversation.
Friends, our final words on new stock ideas. Treat them like sushi. Whether or not you're going to consume that sushi is going to be heavily affected by who gave it to you. If a rando on the street gives you sushi versus your best friend,
I'm going to make sure that I put the outro music on right during this part so people know they're near the end and they can just skip.
Treat your stock tips like people giving you sushi.
Oh boy.
You're going to make better decisions just based on that one thing. Okay, friends, as always, just a reminder, we love to share our answers to these hard investing questions, but it's up to you to find your own answers. It is up to you to decide whether you're going to eat that sushi or do some due diligence on where that sushi came from. You know what? That's a metaphor. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.